There's so much misconception when it comes to tax brackets. How many times have you heard people say, I don't want to take on a new job because I'm just going to get taxed way too much and it's not worth it? Today I'm going to debunk some of that and explain how the tax brackets work here in Australia. Hello everyone, my name is Ethan Rooshocks and today I'm talking about the tax brackets. So I'm talking about individual income tax brackets here in Australia. So what I'm going to do is go through what the individual income tax rates are here in Australia, how they work, and why in 99.9% of situations it's always best to be earning more income. Now before I get into the next part of the video, I really would love for everyone to check out the Rooshocks Discord. So the link will be in the description down below, but it's a great place for you guys to come over, hang out with the other people from YouTube here. I've got people from my Rooshocks accounting business. I've got people that aren't clients. It's just a great place for us to all hang out. I can answer tax questions. We can talk about business, crypto, NFTs. It's really exciting. I really want to reward my community, so I've got lots of exciting things planned. So make sure you definitely head over to the Discord. The link's in the description. Now let's get back into the video. So I'll jump right into it and bring up the tax brackets here. And so as you'll see is that from 0 to 18,200, there's no tax. From 18,201 to 45,000, it's 19 cents for every dollar. From 45,000 to 120,000, it's 32.5 cents for each dollar. From 120,000 to 180,000, it's 37 cents per dollar. And then 180,000 plus, it's 45 cents per dollar. And as you will see here, it only applies to the dollars in the new bracket. It doesn't affect the existing income you've earned. So a really easy example of this is if you earn $20,000, that first 18,000 is tax-free, and then you're only going to pay the 19 cents on the dollars over the 18,000. So in that case, it's only going to be on the $2,000 between 18 and 20,000. Now in that situation, there are some other offsets that I'm not going to bother covering because it's a bit more in depth. But the basic concept is the actual income tax side of things only applies based on the bracket you're in to that income. It doesn't affect the previous stuff. And that's where people get really confused. They think that, well, if I earn more money, I'm going to pay more tax and it won't even be worth it. I'll end up in a worse off position. But that's definitely not true. So what I'm going to do here is use a $10,000 example and show how it would be taxed at different levels. So obviously if you're in that lowest tax bracket, there's going to be $0 of tax on it. When we jump into the next tax bracket, we're talking $1,900. We then jump up to $3,250, then we jump up to $3,700, and then the final tax bracket, anything over that $180,000 would be $4,500. So you can see there is a variety of tax rates on that $10,000 depending on where you fall. But you can be assured that if you earn $10,000, the maximum tax you're going to pay on it is $4,500. It's not going to be more than $10,000. From that example though, you can see that there is a difference when you're jumping between brackets. So it can make sense if you've got one-off income events such as a capital gains event to be a bit careful on planning, well, when is that going to fall based on what other taxable income you might have. So for instance, if you know next year you're not going to be working at all, well, if you recognize up to $18,000 of capital gains, for instance, you're not going to pay any tax on it. Now, if you recognize those same gains in a year where you've already got over $180,000 of income, you're obviously going to pay 45 cents on every dollar of those gains. So you can see there's a significant difference. So just moving between these brackets, if you look at the difference between the two withholding rates, that's going to be the approximate percentage that you'll save by recognizing it in an earlier year, for instance, or maybe in a later year when you're on a lower tax bracket. Now, the other thing that these brackets don't include is the Medicare levy. So the Medicare levy is a flat 2% rate. This kicks in at, I believe, about $23,000. It's got a bit of a tiered system to start with. Pretty much once you're earning over $30,000, you know you're going to be paying that flat 2%. So it's pretty easy to work that out. You add an extra 2 cents for every dollar when you're looking at those higher tax brackets. So in general, it's going to make more sense for you to earn more money. If you take on an extra job or a higher paying job, the maximum you're ever going to pay on that is 45 cents. So if you earn $1, you're going to still be 55 cents better off, no matter what. Now, if you're looking at that on a lower thing, again, you're only going to pay approximately a third of what you earn. So again, it's always going to make sense for you to take on a higher paying job or take on the ability to earn more income, because it's only going to affect those new dollars where the tax rates apply. It doesn't impact the previous stuff. Now there is one really weird situation where maybe it might not make sense to earn an extra dollar, and that's the Medicare levy surcharge. So for singles, that kicks in at $90,000. For couples and families, it kicks in $180 approximately. But what would happen there is that if you earn, say, $89,800 and you had the ability to maybe take on an extra overtime shift in the last couple of weeks of June, that could kick you over the $90,000 bracket slightly. So say you earn an extra $400 from that. So that's bumped your taxable income up to $90,200. Now the downside to the Medicare levy surcharge is that it's 1% at that stage of your entire income. So you're going to pay $902, and that's going to be more than what you actually earn. So the only time it might make sense to not earn an extra dollar is when you're really close to that Medicare levy surcharge one. Now the reason for this is because all our other tax brackets are progressive. You pay it as you go over the new bracket. But the Medicare levy surcharge is based on your entire taxable income. So therefore, if you go over it, it straight away starts at $900. So it's a bit of a weird one. There's a few other bits and pieces like that in our tax things. But in general, it's gonna make sense for you to earn more income. I hope that's explained it well. It's really an interesting topic, and I hear so many people giving out false information when you can just search this up. It's on the ATO website. There's lots of free calculators out there so you can work out what the tax would be on different incomes. It's really easy to work out how much tax you'd pay on a lump sum income because you just work out what bracket you're in, what's the rate, times that out, and you can work that out. So don't hesitate. If you've got the ability to earn more income, it's gonna make sense. You're not gonna end up paying more tax. Don't stress about that. I hope this video has been helpful. Go and check out some of the other content I've got on tax related topics, and I'll talk to you again on the next video.